of all, thank you very much for taking time out of your schedules and giving me this opportunity to express my views. So, as a fund manager, whenever I travel, whenever I meet investors, distributors, one question which is often asked to me is this the right time to invest? Market क्या लगता है? Market should आगे चले. And honestly, whenever I try to give a positive answer that I feel market looks good, I typically get 3-4 arguments telling me why this is not the right time to invest. And when I say that market doesn't look good, I typically get 3-4 responses saying that why this is good time to invest in the market. Honestly speaking, in my experience, this is the most difficult question I have ever found to answer. And honestly speaking, nobody really knows that what markets will do tomorrow, what markets will do a week down the line, what markets will do probably a few months down the line. But I still believe that if you look at Indian equity markets, then we are in a sweet spot. If you are willing to look beyond near-term volatilities, Indian equity markets present a unique opportunity for wealth creation. In next few slides, I'll try to tell you why I believe so, from where this optimism comes. So, this is one chart which I would like to highlight, that is about India's demographic dividend. I'm sure all of you know that India is one of the youngest countries in the world, with more than half of our population is below 25 years of age. If you look at this chart, you can see that this orange line shows China's population and this blue line shows India's population. That by 2030 or so, India's population will actually take over China's population, and India would become one of the most populous countries in the world. But more than this is the chart which is of importance. So in this chart, if you see, this basically shows working age population as a percentage of total population. So you can see that India is a very young country, and India would continue to remain a young country till around 2035-2040, because till that point in time, India's working age population as a percentage of total population, it continues to go up and it remains there. Whereas all other economies, the major ones, whether it is US, China, Europe, they peak out much earlier and they start to go down. Now, don't look at this just as a statistics. This is a very important data point, because we have seen historically in any economy, whenever you have a favorable demographics, it eventually turns out to better growth prospects. And if the country manages its policy well, this is the time when countries' economies they really become rich. You can see how India has changed in recent times. So, for example, if you look at 1991 data, India's population was roughly about 89 crore or so. If you look at 2018, India's population was around 130 crore. But the bigger thing is, in these 27 years, India's GDP has become 10 times, and per capita incomes have moved up from $310 to almost close to $2,000 or so. We have seen that the literacy rates have gone up, life expectancy has gone up, and at the same time, India has become more urbanized. So, in 1951, wherein only 15% of population used to live in cities, today around 35% of India lives in cities. So, the point which I am trying to drive is, when you have favorable demographics, that means more and more people starting to earn. That means per capita GDP will start to go up. So 2008, our per capita GDP was around $1,000 or so. We are close to around $2,000 or so. So the point to note is, we took 17 years to reach from $300 per capita GDP to around $1,000 per capita GDP. But we'll take just 10 years. We have taken just 10 years to reach from $1,000 to $2,000. But next $1,000 will come in just next 5 years. So 17 years to reach from $300 to $1,000, 10 years to reach from $1,000 to $2,000, and 5 years to reach from $2,000 to $3,000. Now, this number is of significance because historically, again, across the economies, we have seen that whenever economies cross this threshold of $2,000 per capita GDP or so, there are many categories which go through an inflection point. Probably because at $2,000 per capita income or so, your basic needs are met and you are willing to spend on improving the quality of your life. That is when the real inflection actually comes. Second reason because of which you should be positive on India is because of the reforms which have happened in recent times. We can talk of many things, but few things which I believe are very, very significant. And we believe that we will see the impact of these reforms going ahead in time. So one is GST. So today, many people say that GST, everybody used to talk about GST, it has come and gone, but nothing much has changed. Let me tell you, a lot of things are changing on the ground. We have not yet seen implementation of GST in full architecture. Once the system settles down, full-fledged implementation happens, you will see that the shift from unorganized sector to organized sector, that would meaningfully accelerate. You would see that the incentive to deal in cash, that would continue to go down because of number of steps which government has taken. GST is one of them. I'm not saying that cash economy will completely disappear. That will not happen. But increasingly, people will find it difficult to deal in cash, and it would make sense to pay taxes and be a part of organized economy. Second important reform which has happened is Insolvency and Bankruptcy Code. I believe that 10 years down the line, when you would look back and think of big reforms which have happened in this country, IBC, that is Insolvency and Bankruptcy Code, would really stand out because this has the potential to bring a complete transformation in the credit culture in this country. So, for example, earlier it had become kind of a business model that you borrow from a bank. If the project works, great, you make money. If the project doesn't work, it's not promoter's problem, it's bank's problem, it's bank's NPA. Today, thanks to Insolvency and Bankruptcy Code, we have moved beyond that stage where there is a real risk that a willful defaulter will end up losing his business. We have seen some transactions already happening under IBC. This is a new law which is getting tested in the courts. But the way case laws are building up, the way things are progressing, I think we will see significant progress on this going ahead. So I think these two steps, which means more resources available to government, more resources to deploy in infrastructure, more resources to improve the efficiency in the economy, productivity in the economy, means that India's growth rate for a reasonable time to come should remain healthy. Finally, I want to highlight this point regarding volatility. I said that people ask me what is the best time to invest, and I find it one of the most difficult questions to answer because volatility is something which is part and parcel of this asset class. We say that you can't time the market. Nobody can project, forecast how markets will move in next one quarter or next 6 months or a year, but you can get it directionally right. But to benefit from it, you have to live through the volatile phases. Those of you who have invested in the market or are associated with the market since last many years would know that it's very common to see 20, 30, 40% kind of corrections happening in the market even during a bull run. So for example, in this chart, this is from 1992, red lines show basically what kind of corrections we have seen from the highs to the low point. And you can see that from 2003 to 2008, which was the raging bull market, we had two instances wherein markets were down by about 30% or so. So the point is, if you want to make money in equities as an asset class, you will have to live through the volatility. Instead of trying to time the market, you will have to spend time in the market. That is of essence. This is chart of BSE Sensex starting from 1991. You can see that at any point in time, there were a number of instances, issues, concerns events which have played out, whether it was Southeast Asian crisis, whether it was LTCM crisis, whether it was 2008 global financial crisis. If you have reacted to these volatilities, you have ended up paying a price by getting out of the market at the most wrong possible time. So the key is, if you would have remained invested, probably the experience would have been like this. So for example, BSE Sensex Index, the total return index, which includes the dividends as well, has delivered over a 10-year period about 16.5% returns, which is a very healthy return. Even if you make adjustment for tax, I think this is the best possible return which you could have earned in any instrument which is available to Indian investor. Similarly, if you are willing to take more risk, willing to live through volatility and invested in mid-cap category, then the index has given about 19.5% returns. So I have also put what is the average returns delivered by mutual funds. So around 18% and 22%. These are category averages. These are not the best returns. So this includes the performance of best funds as well as performance of worst funds in the category. Finally, just to conclude my presentation, I would like to highlight, don't try to time the market. It's very difficult to time the market. Focus on spending time in the market, think longer term. India presents a unique equity investment opportunity because of the drivers which I just mentioned. Key is remain invested and don't react to the volatility which is part and parcel of the market.
Rupesh, you highlighted the importance of staying invested or remain in the market rather than out of it. So why do you think that people, despite fund managers like you, even mutual fund advisors, the financial planners making these points again and again, people tend to try to time the market or otherwise they look for some secret form and in that process, get transformed?
So I think the thing is, it's our human tendency that we want to react to any situation. So they say that compounding is eighth wonder of the world. But I say that compounding is something which is very basic, which is actually taught the formula A is equal to B into 1 plus R by 100 raised to the power n is taught in 8th standard maths. But we find it very difficult to imbibe it. Now compounding is something which is very easy. So a lot of people are aware of it because there is a lot of material which is available, a lot of fund managers talk about it. It is difficult to capitalize on. Because to capitalize on compounding, you have to do nothing, stand still, which is the most difficult thing to do. So I think because of this very nature of reacting to the things, reacting to the news flow, trying to anticipate the outcomes, and then trying to make that decision by which you can outsmart the market moves, that leads to this wrong decisions. Secondly, I believe that again and again, I mean, we have seen it number of times. I can give some examples also. So, for example, this election thing. A lot of people say that if election results play out in a certain way, then markets would react positively, or otherwise markets would react negatively. So, let's look at one example. Let's say 2004. When the expectation was that NDA will come to power, that did not happen. Markets reacted. I think for 2 days we were on down circuit. But if you would have reacted to that event, you would have got out of the market. You actually missed on the biggest bull run which happened in India and went on till 2008. So I think this is one thing. And second, typical investor behavior which I have seen is investors, they tend to chase historical returns. So this is a classic mistake. So if you are investing in property as an asset class, you would wait for an opportune time wherein you would say that, okay, let prices correct and then I would buy the property. But in case of equity markets, really investors want to invest and prices have already gone up. When you see that your friend has made 80% return, and then you say, oh, let me get money out of my fixed deposit and put money in equity markets. I think that is one thing which is a typical behavior to equity markets, because of which investors fail to capitalize on it.
I'm glad that you spoke about the election. It's not just the election, there are a host of negatives for the market. For instance, the job data is like extremely disconcerting. So when these negative things are there, the most investors think that, let me play it safe, stay on the sidelines. So it's like a very normal human psychology. So what would you say to these investors?
So one more point which I would like to add here is why this behavior. This behavior comes because you are able to see your enemies on every day. So that's why you see that, okay, I mean, I had invested 100 rupees, today it has become 99.5, I mean, then day after you see that it has become 98, so you want to just react to it. But when you buy, say, property, you can't check its prices on everyday basis, and hence, even if there is a negative news, you can't react to it because you don't see the prices. So I think treat equities like that only. It's an asset class where you have invested for longer term. Market is there, it gives you a prices. Lot of those prices are very random prices. Lot of data which comes is very random in nature. A lot of that data is very post facto. You did not react to everything, and I think that is the way to make money in markets.
We are in a city where long term is like a few weeks or a month. So what would you like to tell?
I think, so I will go back to the starting point. Honestly, if you have made money in 1 week, 1 month, consider it fluke. I mean, consider it was your luck. But real money gets made over a longer period of time. I talked about this compounding formula. I think the most important part in that formula is N. So the number of years which you have spent in the market, not really, I mean, are the rate of return. You may make 20% in say 1 month's time, and you may be celebrating it, and if you annualize it, it would look a very great return. But I would say 15% compounded over 10 years will change your financial orbit.
The last year was pretty tough for the market, especially for mutual fund investors, because most of the schemes have given negative returns. So, what has been the investor behavior? Because fund managers like to always say that since 2008, we have seen the investors, especially mutual fund investors, act in a very mature way. So, does that still hold?
Yeah, so I think I would tend to agree with you that we have seen, thanks to the good works done by people like you, the maturity of Indian investor has significantly improved in last few years. I think people are willing to remain invested, people are willing to see negative returns. I think the way SIPs have become popular, people have started understanding importance of rupee cost averaging. And I have seen that even in this recent correction, investors, domestic investors, they have kept faith in Indian equities, and it has. I mean, we have seen it in terms of SIP flows which are coming into the funds. Only thing is, I believe that now probably we have come to a stage where in last 2-3 year returns are not looking very great. Whether investors will keep their patience or not. But in my experience, I have seen that when historical returns are not looking great, that is probably the best time to invest in any asset class, and that applies to equities also.
Tata is known for its conservative approach, no nonsense behavior. So when you speak to investors, like what are the things you want to convey to them, especially when it comes to equity investors? If you have a very long-term investment horizon and you're like your risk profile allows you to do that, invest anytime, start, is that the whole thing to it?
Yeah, so typically for an investor, we say that equity is a volatile asset class, you can't time it. So when you can't time it, the best way to capitalize on this is that you go via systematic investment route, wherein you invest a set amount of money on a regular interval, because that's the way you can capitalize on volatility. Secondly, in terms of returns, I would say remember one thing, that in any economy, your longer term returns from equity as an asset class are in line with the nominal GDP growth. So your return expectations should be in line with the nominal GDP growth. Within that, you would have phases where your returns would look very superior depending on the level from which you are buying, or it may look a bit inferior if you have bought at very high valuations. But remember, in terms of expectations over a very long period of time, equity returns, they resemble the nominal GDP growth in the economy, which we can say would be in the range of 11.5 to 12%.
And GDP number plus the
Yeah, plus the inflation. On top of that, active funds have added around 2% alpha to that. So you can expect that over a longer period of time, 14.5% kind of compounding is what equity as an asset class can be.
We'll take a few questions, please. Okay, first question. Yeah, the gentleman on the second row. The mic is.
Sir, good evening. Sir, I have a small question that in markets like these, I have, in my limited experience, there are two major incidents that I think any mutual fund investor should look at. One was in 2018 when most of the fund managers did not, whatever there was a depreciation in the value of the underlying equities, they were not passed on to the NAV and they kept it on their books except maybe Mirai Asset Management. And secondly, in 2017, when the valuations and the P's were at all-time high, still fund managers were very aggressively pushing for inviting investments and advising people to take invest in mutual funds. Looking to this, I would say that on one side, fund managers were continuously advising that the valuations are not very nice, and still they were pushing SIPs and mutual fund investment. So, are there some kind of funds which a normal investor should stay away from, or are there any red flags that an investor should be looking at?
The first part of your question is not very clear. What do you mean by funds not transferring?
Well, according to what I've read, I think that at the time of the decline in 2008 and the years after that, a lot of fund managers did not allow the NAVs to reflect exactly.
They can't do anything about it.
I think this question is related to debt funds.
Funds.
Yeah.
No, we are talking about
Debt funds, not debt.
So maybe I think in 2008, some of the fund houses had taken those losses on their books, but those were very few and far incidents there. But logically, now it's not allowed.
Now side pocketing.
Yeah. Now side pocketing comes into play.
And so
On the valuation and all. See, again, I would go to my original point that timing the market is the most difficult thing to do. Even fund managers like us cannot really see that markets are going to correct tomorrow or all. So let me give you an example. If I would have come to you in 2007 and I would have said that markets are expensive, so I want to be in cash. Let's say I'll keep my fund 20% in cash. I would have come to you in January 2007 and said that. And then if I would have met you in June 2007, you would have told me what kind of a fund manager you are, because markets are doing so great, you are sitting in 20% cash. So the thing is, you can't perfectly time it. The key is why systematic investment plan, because markets would remain volatile. From which point it will turn, we do not know. But directionally, these are the fundamental things which are happening in the economy, because of which you should remain positive on equities as an asset class. I think the investment framework for investing in India is very simple at one level. So the way to think about it is, see, in any economy there would be businesses which will grow either in line with nominal GDP growth or more than nominal GDP growth. So if you find a business which has potential to grow more than nominal GDP growth, it's run by decent managements, balance sheet quality is decent, you need not do anything, you just have to buy those businesses and sit there. You will go through ups and downs, but over a period of 5 years, 7 years, this nominal GDP compounding would eventually reflect into stock prices. Because at the end of the day, stock prices are nothing else but slaves of earnings. So if your outlook on earnings is positive, it has to ultimately reflect in the stock prices.
Next question. There.
Yeah. Sir, hello.
Yeah.
Sir, I want to ask, there were two scenarios historically when the P of Indian equity, Nifty P was near about 25, 26, touching the level of 27. and current FDP was also touching the level of 27. So, wouldn't a normal sane person would say that no matter how well GDP is growing, but earnings are not growing of companies. The valuations might be growing, but earnings are still stable. So it is at an expensive reason. And those two incidents, when those two incidents happened, after that there were big crashes all the time. And we have seen since last 2 to 3 years that our valuation has been stable at 27, 28, 29. So how can we justify that?
Okay. So when we talk about valuations, I think this index level valuations is, I believe, too much of simplification. Because, okay, let's look at Sensex. Now, what is the composition of Sensex? On one hand, you have a global commodity company like Vedanta or a Tata Steel. You have a company like Tata Motors whose fortunes are more linked to what happens to JLR outside India. You have a long-term structural compounding story like Hindustan Unilever. You have banks like HDFC Bank. You have NBFCs like HDFC Limited. You have PSU banks like State Bank of India. Now, all these businesses are as different as chalk and cheese. They have very different drivers. They have very different return profiles. And when we try to measure all that using one single metric, which is the index P, many a times it tends to mislead. And I believe India is a growth market. There are a lot of companies beyond index which have grown at rates which are much better, much superior to what we see in case of index earnings. And that is where the real opportunity lies. So, for example, till 2017, we saw this correction in mid and small caps in 2018. For many years, mid caps and small caps as a category did very well, whereas Sensex was not going anywhere at that particular point in time. The reason was that most of the large cap companies, they were exposed to global business cycles, and global GDP growth was not very healthy, and their fortunes were linked to what is happening in the global economy. Whereas the domestic side of economy was doing very well. Many of these mid-cap, small-cap companies, they were focused on the consumer side of the economy. They were focused on segments where, the runway for growth is huge. They were focused on segments where there were only 2 or 3 organized players, and unorganized players were consistently losing market share to organized players. Or they were having some brands, because of which the outlook on earnings growth and current earnings growth were very, very healthy, and that's why small and mid caps did very well as compared to the large caps. From there, we shifted to a phase wherein global liquidity turned, globally interest rates moved up, so theoretically your PE ratio should correct, but businesses which were linked to global business environment, they started doing well. We saw commodity prices going up. As a result, some of the commodity companies benefited. So that's why right now we are seeing that there are very few large cap stocks which have taken the index up. The distribution is not very even, and with time this concentration has gone up only. So that is why if you look at the dichotomy in the market, last 1 year I think Sensex Nifty returns are about 3.5%, 4%. But if you go deeper and look at the mid-cap index, it's down by some 17-18%, or the small-cap index which is down by 30-35%. So my argument is that if CY17 one was so confident on mid and small-cap categories because of the fundamentals, today your fundamentals are very much intact, but the valuations have corrected significantly. So no point in just looking at index valuations and drawing conclusions that markets are very expensive and we should not be investing.
Next question.
Next question.
Yeah.
Sir, as a fund manager, how do you pick up quality stocks, specifically in the small cap and the micro cap segment? I mean, the small cap segment has really taken a hit since last few months. So there are a few metrics like debt equity ratio, interest rate holding. But how do you go beyond these factors to really find those good stocks which can be managed?
So typically what happens is, I talk about Tata Mutual Fund. So we have a dedicated research team which has research analysts, and then we have team of fund managers. So our research analyst team, there are sector specialists. so they know their sectors in and out, and so their responsibility would be to track companies in that particular sector. Now there are some 6,000 odd listed companies. Obviously, I can't track all of them. So what we have done is that we have an approved universe of stocks. So around 350, 400 stocks that forms part of our approved universe. And when we include a stock in our approved universe, so before that there is a very detailed due diligence happens in terms of meeting the management, meeting the customers, the suppliers. You analyze their financial accounts in detail. At times, I mean, many sell-side analysts who track these companies in great detail, you interact with them. And then based on all these inputs, you take a decision that whether this company should be part of our approved universe or not. And only when the company becomes part of this approved universe, a fund manager can buy this particular stock.
Next question. Okay, the last one.
Hi, sir. My question is like for lump sum investor, what should be the correct time for the investment? When they should go for investment? Like I had to transfer my money from liquid fund to equity fund in Jan 18, but after that it is whole year. Still I am in the minus side. So I was just wondering, like, what would be the correct time for lump sum investor for investing? How
So I'll again go back to my starting point. Difficult to time the market. Best way to gain from equities as an asset class, being a volatile asset class, is to come through systematic investment plan. But still, since you asked about lump sum investments, I think best time to put lump sum money in equity markets would be when no one wants to put money in equities. When everyone wants to sell and put money in fixed deposits or buy real estate, but wants to stay away from equities because historical returns are looking bad, no one is making money, probably that's the best time to put lump sum in equities.